All right. You guys ready to go? All right. Well, as always, appreciate everybody being here. Before I get started, just want to take a quick minute to be thankful for living in the greatest country in the world and for all the veterans in the room. So if you guys would join me for just thank you for your service. All right. Well, so today's topics. So this one is an interesting one. I actually had a client of mine who I think has come to just about every one of these events who I asked him if he was going to be here, and he said, that topic doesn't really interest me. So it's a little different topic today, a little out of my norm, but as you all know, the topics are really generated by what we hear from people that are coming into our office and what we hear in the media, right? So our objective is, I may go down, there's a lot of cords around here. Our objective is always just to try to bring a little perspective, right? We get our information from a lot of different places. My dad is famous for saying, but I read it here, and obviously not everything we read is true, and that gets even more complicated with the internet and the 24/7 news cycle. So hopefully that doesn't happen that often. So the topics today, just a couple things that that we've been hearing. One is the conversations around the dollar. I think most people have, at least at some level, heard conversations about the strength of the dollar and is the dollar going to be challenged as a reserve currency. I've actually had a couple speakers who've addressed that, and so I'll try to just bring a little context to that. Of course, the tariffs, which are always difficult to talk about because it's hard talking about tariffs without seeming political, so I'm going to do my best to stay right in the middle where I belong in that conversation. And some talks about inflation, currency risk, and portfolio construction. These are all tied together, I think, right? The narrative that we're hearing around these topics is definitely connected. And so when we talk about the strength of the dollar, it brings currency risk into play. I think currency is oftentimes not fully understood, and so I just want to try to bring a little perspective around how we think about currency. And then I added this one last minute just because we've heard a bunch recently about the AI bubble, so I wanted to spend a little bit of time on that as well. So when it comes to the dollar, I think when we think about the dollar, the main things that we're thinking about is, one, the reserve currency aspect, and two, how it might impact our investments. So I thought it'd be interesting to learn a little bit about the dollar in terms of some historical context. There's really these key events that you can go through that lead up to the dollar in terms of, one, being the reserve currency, and two, being what it is today. And that starts with the Coinage Act, Smoot-Hawley, Bretton Woods, the Nixon shock, the Forex, and then we'll talk more recently about the global challengers. Some of you may have heard of some of these things or remember back from school. I may end up having to just walk over and press the button. So hard to have a history of the dollar without talking a little bit about gold. By the way, everybody complains about my slides are hard to read, so I went out and had Schwab buy these new TVs. Hopefully those are helping you guys see that stuff. I will try to point out, I'm getting data, especially in this presentation, from the IMF, from Fred, some institutions that are writing these data points, not necessarily for presentation. So I'll try to make sure that I point out the important aspects. You can see down there on the bottom left, 1792, the Coinage Act, which really established, after the U.S. mint, the dollar as the official currency. And then it's kind of interesting, I think, if you look at the boxes across the bottom of that graph, where you can see it says bimetal standard, mostly silver, mostly gold. Then we move to the pure gold standard. Then gold is backing the dollar. And then in 1971, Nixon changes that to where we move to pure fiat currency. And so there's that period from the circle up at the top, 1933 to 1971 and going forward, which has really kind of laid the groundwork for what the dollar is today. And one of the things that is interesting to think about in that discussion is the Smoot-Hawley Tariff Act of 1930. Anybody remember that from school? Yeah. Now, I didn't mean to remember that from being there. Jeez. God. All right. Yeah. I'm trying to keep you all as clients, not get fired out there. So Smoot-Hawley, pretty interesting, and it's interesting because it has implications to the dollar, and it was also something that causes concern around current tariff policy, because what that really originated from was going into the Depression, there was a lot of concerns about industry, and particularly farmers, and they were trying to figure out how to generate and stimulate the economy. And so Willis Hawley and Reed Smoot, they sponsored a bill that levied really significant tariffs worldwide. And it was really designed kind of from a protectionist mentality to try to generate revenue and help the farmer. Unfortunately, it didn't work that way. It was passed through the Senate in 1930, and it was pretty problematic, halting foreign trade to estimates up to 60% of foreign trade reduction. And it's widely considered one of the things that led to kind of more magnification around the Great Depression. So it isn't exactly the same, and I'll talk a little bit about that, but some of the reasons why people have concerns about current tariff policy is because of what we saw back in the 1930s as a result of the Smoot-Hawley Act. How it's tied into the dollar is really because of what was done to try to correct some of the problems that happened with Smoot-Hawley, which was Bretton Woods. And so after the Depression had kind of run its course and into World War II, countries around the world were trying to figure out how to resume trade and to bring about more revenue from a global standpoint. And so 730 delegates from 44 countries met in Bretton Woods, New Hampshire. Anybody ever been to Bretton Woods? No? For what was called the Bretton Woods Conference, and it turned into the Bretton Woods system. They really had two goals. Goal number one was to establish a reserve currency worldwide. And goal number two was to establish a fixed rate of exchange. It could be adjustable, but a consistent rate of exchange. And so out of Bretton Woods came the US dollar as the reserve currency. It's where the dollar was backed by gold at a price of $35 an ounce. And it was expected that countries would maintain their currency within 1% of the price of gold. And so this is really what began kind of the golden era of the dollar. So this is when the dollar really took off and became much of what it is today. And again, it was as a result of some of the concerns that came out of Smoot-Hawley. And so that's why, even though Smoot-Hawley was really more of a tariff thing, it somewhat indirectly led to the dollar becoming the reserve currency because of the things that were needed to try to stop it. You guys have heard me talk about, or you've heard people up here that have talked about this particular, or these particular characteristics. And so the question becomes, why the dollar, right? Obviously the US was starting, continuing its economic power, but those are really the three reasons why the US dollar was selected to be the reserve currency. And there was a question from an economist who spoke a while back from State Street, and it was somewhat along the lines of what we're talking about today, where somebody in the room asked them about the dollar. These were two guys back to back who took open-ended questions, and so they didn't have any presentations, they just took questions. That was one of the questions that came up, and they pointed to this as well. It's easy sitting in this country, especially with the polarized world that we are in today, to feel like we don't have stability in our government. But when you think about us worldwide and you think about the characteristics that it would need to be the reserve currency, these are the reasons why it ended up in the US. One is the stability of our government. Two is the strong rule of law, which is intended to be held accountable across everyone. It's not a caste system. And then three is the liquidity in the financial markets, which was really largely aided by the creation of the Federal Reserve in 1913 and what's called open market operations, which is where the Fed facilitated trading with banks across the world. So this is really the three reasons why the dollar is the reserve currency. I'm going to skip that. Then we get to 1971. And the Nixon shock. And so many of you probably do remember that one. That's not meant to be insulting. But as you know, the suspension of convertibility of the dollar, the implementation of wage and price controls, and we start a period of more significant inflation. The other thing that this did by removing the gold standard is this officially took us away from a fixed currency situation to a floating currency, which has major implications today particularly as we get to the next thing that happened, which is the advent of the Forex exchange. Forex, anybody have any idea what the daily volume is on Forex? Keep going. Keep going. Trillions, $9.5 trillion a day. So this is where the significant liquidity comes in the marketplace. And there's many things that the Forex accomplishments, but it allows us to convert global currency. It allows us to be liquid within 24 hours in those transactions. It allows businesses to hedge against currency risk. So if you're doing business in other parts of the world and you realize that currency is a risk for your business, you can hedge against that. And then because of that, it really connects economies in a way that was never done before. So that leads us to, if you think about just a little bit of what's been talked about so far, it's really just kind of setting the stage for how did we get here. We have the rule of law, we have the stable government, we have the liquid reserves, we have the Forex, which kind of facilitates that, and then we have the various conditions that and acts that happened in order to get us here. So why are we in the room talking about the strength of the dollar? And specifically, we're doing that because there's narrative now that the dollar is losing some of its status across the world. And I think there's two parts to that discussion. One is, it's probably reasonable that it does, right? It's not super logical, in my opinion, to think the U.S. maintains its position in the world as China strengthens and India strengthens and other things happen across the world. So I think some of it is probably natural. The other is, I don't know that we all know how to digest it, right? What does it really mean? And so there is truth to some of the information about the United States and its status as reserve currency. I'll talk more about this later, but this is foreign exchange reserves. So the money that the Federal Reserves around the country are holding to be able to exchange US dollars, that's the top line there. And you can see that it is trending down. And then you can also see on the bottom there that other currencies are somewhat trending up. So there is some pressure against the United States in terms of the standing of the reserve currency. You'll notice that Europe, the euro is in there. The euro is a little bit interesting, and you'll see it show up again, but in large part because of trading within European countries. Right? It doesn't necessarily have the presence outside of the Eurozone, but it shows up that high because of the trading within the European countries. The other thing that has people concerned about the United States reserve currency status is GDP. And this is where I think it's just a product of size, a product of globalization, that it's not necessarily something we have to be afraid of. I can remember being at a conference probably 15 or more years ago now where an economist was standing in front of the room, and she made the case that at some point it's going to be best if we stop looking at China as a pure competitor and start looking at it as a collaborator, right? And I'm not sure we're there. I'm just saying that it may not be something to be afraid of. Just acknowledge that there is going to be GDP impacts, and the United States probably isn't going to maintain its share as a percentage of global GDP. So those are really the reasons why the conversation exists, and you can find it anywhere you want. All you have to do is do a simple Google search and you'll see all the information. Okay, so what I want to finish up with this in this part of the discussion is just what do we really need to be concerned about? I think it's reasonable to assume that there will be changes over time. The economists from State Street spoke about they're watching the BRICS, right, the emerging market economies, because there is reason to think sometime in the future things may adjust and they may change. I also think it's important to recognize that today the U.S. is still incredibly dominant. And so when you think about all of those reasons why the U.S. has reserve currency status, the third one, or the last one, is the fact that they're just so embedded in the global system already. If you look up there at the top, that's the bank reserves we talked about, 60% of global reserves. And you start getting into international debt, international loans, trade invoices, international payments, all in the 60% or more range. And then you get down there at the bottom, that's the foreign exchange transactions from Forex. 90% of Forex, and I talked to you about how big that number was, is done in US dollars. Okay, and there's a topic for further on in the discussion, but there are a lot of countries around the world whose currency is really not very valuable, and so it's very difficult for them to pay debt back or trade in their own currency. So what currency do they have to get in order to do that? They have to get US dollars to be able to protect themselves from that. So it's not that there's not pressures coming, but barring something that is totally unforeseen in the foreseeable future, I think it's pretty reasonable to assume the US dollar is going to continue its status from a reserve currency standpoint. All right, let's shift gears. My hands start sweating when I talk about tariffs. I think the message with tariffs, again, is not meant to be political. I think, as is the case with everything that I like to talk about, the more you don't have a conclusion, the better off I think that I've done. All right? Because those things that I said, around the dollar, it doesn't say what the dollar isn't going to do necessarily, but it does at least challenge what you hear. And I think there's similar aspects to tariff policy that we can think through as well. Because one of the things that shocks me all the time, I write about it a fair amount, and I think about it a fair amount, is just how certainty shows up in our industry and in our office, right? I always, think about sports, and if you watch the prognosticators pick the football games on Sunday, and then they've missed 7 out of 10 games, and they're back the next Sunday acting like they know exactly who's going to win again, right? This is just the world that we live in, and so, we all know, generally speaking, what a tariff is, and obviously it's been in the news a lot. This is a graph that alludes to what I mentioned earlier about the concerns regarding the current tariff policy relative to what we've seen historically. You can see the last time we had tariffs that were high in the middle of that graph was around the Smoot-Hawley time that I talked about, and the conclusion was that wasn't very, very effective. There are a number of things that are different, and again, the difference doesn't mean that policy is right. I would say above all else, if anybody tells you they know what's going to happen with tariffs, I think that's the people you got to stay away from, because nobody knows. Right? We don't know what the impact is. We don't know if we're going to look back 10 years from now and think it was a great policy or a terrible decision, right? And as much as the team we're on might color that view, I think, somewhere in the middle, there's an awareness and an acceptance that nobody really knows what's going to happen. There are some things that are different. And I think it's also important to recognize that you can see tariff policy really coming out of the Smoot-Hawley period up until now. It wasn't that there's no policy in place. It's just the policy was different, right? There are tariffs all the time from countries all over the world, and they are a tool to be used. Our policy was generally to get what we wanted by keeping tariffs low. And that may be national security reasons, that may be economic reasons, right? And I think that's an important distinction to make as well, because a lot of times when we think of tariff policy, we immediately think of the economic impact. And I'm not sure all tariffs, particularly from the United States, are driven purely for the economic impact. In fact, the national security reasons could be such that you have to accept negative economic conditions for what's trying to be done from a national security perspective. Again, this is not in support of, this is just perspective around this. We also, I think a major difference, which leaves the door open for what would happen, is we didn't have a reserve currency and we didn't have any IMF or World Bank or Forex exchange the last time we saw tariffs like this. And so in the early, part of the century, or the 1900s, around 1930, the currency manipulation and the fluctuation was really, really dramatic, right? There was nothing there to create any stability around that. Again, doesn't mean that it's necessarily good. It just means what it is. I would also say there's pain no matter what. Right? It's important to recognize that tariffs are punitive no matter what. There is no way to get out of tariffs without somebody going through some pain, right? And so even if you think about the period where we were in a low tariff policy, you could argue there's pain. right? There's steel workers that don't, whose jobs got sent overseas. There's plenty of people in the tech industry who lost jobs overseas. There's manufacturing that the U.S. couldn't be competitive in. So I think wherever they are, there's issues, right? There's no question there's going to be pain on either end of it. As investors, I said this to, I was running through some of the presentation this morning with Robert and Will, and I said this to them. I said, I always want to make sure that people recognize I'm not a foreign policy expert. I'm not an economic expert. That's not who I'm standing in front of you as. I'm standing in front of you as your wealth manager. So what are the implications from a wealth management perspective is always important. That's why I get to the Forex and so forth on the dollar. I think from a tariff perspective, you know some of these things, but just to make sure we're on the same page, obviously increasing government revenue, strategic leverage, addressing the trade imbalances from a problem standpoint, retaliatory tariffs, higher prices, supply chain issues, right? We've all kind of been exposed to this stuff. One of the reasons why I said tariffs are always to some degree punitive is because when a product, most people probably are aware, but just to be clear, when a product has a tariff and it comes into the United States, the company who is receiving it has to pay the cost of that tariff to the government at the port before they can get the goods, right? And that's where it's going to be paid for by the company, and then they're going to choose to either take some of that or take all of it, pass it all on to the consumer, or some combination of the two, right? And the idea would be that the more expensive goods are overseas, the more attractive goods are that are produced in the United States. And then businesses in the United States have a difficult dilemma to decide, because on one hand, they could keep goods cheaper. On the other hand, they could see the net expense of the goods after the tariff as the market and raise their prices because they can, because the competition has a higher price coming from overseas, right? So this is the complexity that exists. I think the main thing from a tariff perspective, why I say nobody knows, is because as you saw from that graph, the test cases are pretty minimal, right? We had an experience years ago, and unfortunately, the credibility of economists when the media talks about economists, it's kind of like, I was thinking about, should I go after CPAs? Should I go after attorneys? No, but I think, economists in general, they get, what's the word? Kind of a given credibility. But if you think about 2022, I'll never forget the fact that economists said we were all going into a recession. I mean, every economist on TV says we're going into a recession, and then they said not the first quarter, the second quarter, and then not the second quarter, the third quarter, and then not the fourth quarter, maybe early part of next year, and then all of a sudden the economists say it's not a 100% chance of a recession anymore, it's a 45% chance of a recession, right? It's like the weathermen who seemingly don't understand what a 100% chance of rain is sometimes, It's like, for me, if there's a 100% chance of rain, I should be wet when I stand outside, right? So I think you just have that, I have that thought around the predictions around tariffs. I think the use case is minimal because the only real test case we have in the current economic environment and monetary environment is Trump's first term in office.
Eric, I'm sorry to interrupt your presentation. Where's the previous chart? Where's the leverage? It seems like that chart says it is what it is. Tariffs coming in and people have to pay ours.
Oh.
But you talk about leverage. So where's the leverage?
Well, again, I'm not a tariff expert, but I think the leverage it's causing quite a bit of pain on the exporting economy. And so it's just how much pain they're willing to go through, right? I mean, if you think about China, China's economy is suffering. So it's just a matter of how long the powers that be want to continue to, hold their ground, I guess, right? I don't think the leverage is in the product on the tariff itself. And again, I'm not an expert. So I don't think the idea that that somehow the exporting company is really going to change their price. I'm not sure that's where the leverage is. I think it's in getting them to do what you want to be done because of the economic pressure. So when we get back here, this, again, it's a small sample size, right? But the first term, Trump raised tariffs. There's two things that we're thinking about. Again, getting back to the kind of the role as a wealth manager, investment advisor, what are we thinking about in terms of how we can help you? Well, we help you get the income that you need to live on, which inflation would be a negative consequence to that. And of course, we help you invest in the market. So if we do look at this period of time, is there anything we can take away? We can generally take away that the first time tariffs were high, it never actually got passed through. You'd have to maybe assume that the businesses just ate it. I think it was a little bit of a different time then because there was no inflation. This was pre-2022. And you guys have all been in industry somewhere where nobody wants to be the first to make the change, right? I think in some levels, if you had passed through the prices in 2017, 2018, maybe there's a concern that it wasn't kind of accepted at that point that there was inflation. Now we've all accepted it, right? Now we already know that we're going to buy a sandwich for $12 instead of $8. So it's kind of got, that momentum is already there. Looking forward to today, you can't see a whole lot of response yet in tariffs from inflation. It doesn't mean that it's not coming. You can see a little bit of a trend up in core CPI, which is that figure there on the bottom. So I think that's what's going to be interesting to watch over the next, several months to 12 to 24 months. Tariffs account for about 0.3% of GDP. So sometimes it's kind of hard to know what's actually causing this stuff. There's obviously a very dynamic environment with a lot of things moving around. And then I've shown this before, but this is the other concern about tariffs beyond the economic concerns in terms of inflation would be the investment concerns. And what you can see here is this is the return of a dollar through the last period of tariffs. And you can see the top is China, the middle is the United States, and then the gray box is the place where there weren't any tariffs, right? The tariffs were between China and the U.S. Both the two countries with reciprocal tariffs over that time frame outperformed the countries that didn't have any tariffs, which would be the rest of the developed international world. Again, this gets back to what I was trying to say before, which is, does that mean we won't see significant inflation with tariffs? No. Does it mean there might not have some impact on a negative into the market somehow? No. It just means it's not a guarantee. So when people say tariffs are going to cause a problem to the market, we have data that says maybe not. When they say tariffs is going to cause rampant inflation, we have some data that says maybe not. And it's just, I think about this a lot, but over the years, my mission statement has changed a lot. Now it's to give you full confidence so you can go enjoy your retirement. I think the best way at times we can give you confidence is just to give you a little bit of something to challenge the negative stuff that you hear all the time. Just so you know, maybe, maybe not. I've done it with recessions a lot, right? There's not a person in here that I'm sure doesn't think in general recessions mean bad markets until you see the data and you say, wow, 5 out of the last 11 recessions, there have been positive returns in the market. So at least when you hear people talking about recession, it doesn't necessarily automatically mean that the market's going to be negative, which helps you stay in your seat. Now, currency. Currency is the thing around currency is it's an overlooked asset class. What I mean by that is oftentimes when people are invested in foreign stocks, they think the return is solely a product of the stocks that they're invested in, and it's not. It's a product of the stocks they're invested in, but it's also a product of currency. Okay, and so the rate of return that you get is not just about the investments themselves, it's about the investments themselves and the rate of change between the currencies of the countries that are being invested in. Currencies fluctuate, right? They fluctuate just like stock and bonds. There's prices all the time that you have to be thinking about. They're affected by interest rates, and they affect corporate profits, especially as we have more multinational corporations, right? One of the things about currency risk with multinationals is they're receiving revenue from overseas. And so how the dollar impacts that is a relevant thing to think about, right? And I think, again, we break that down into generally 3 categories. What's the economic reasons to think about currency? What are the stock market reasons to think about currency? And then what are the debt reasons? By debt, I mean bonds in our case, because we're talking about as investors. So, I think, I don't know, in general, show of hands, how many people think it's better to have a strong dollar? How many think it's better to have a weak dollar? Okay, well, I think that's pretty interesting. I didn't expect quite that level of agreement across everybody. I think one of the things I'd like to reframe is it may not be always better to have a strong dollar. I think, I don't know exactly where the idea comes from in its entirety to have a strong dollar. I think maybe it just feels like the U.S. is strong and we're a strong country, and so having a strong dollar is in our favor. And there are definitely pros about strong dollar. We have cheaper imports, we have greater purchasing power globally, and we have cheaper travel abroad. But some of the negatives and challenges are U.S. exports become more expensive. And this is directly related to our reserve currency status as well. Because if you think about what I talked about earlier in terms of countries know that they hedge their own currency risk by owning more U.S. dollars, that's going to create more demand for U.S. dollars, which is likely going to potentially to some degree artificially drive up and overvalue U.S. currency, which I think, getting back to some of the pain that you have, there's been pain associated with a strong U.S. dollar, right? And just in my lifetime over the years, especially when I feel like maybe just as a younger person, I wasn't aware of the politicization of these concepts. But I think there were periods in my life where the jobs going overseas, right? We've now accepted globalization, I guess, but now that transitionary period, there was quite a bit of upheaval, I feel like, when I was a kid about, you don't call anybody on the phone and who knows what they're doing, and your jobs, people are losing jobs and industries are going away. So there's implications on both ends, right? I talked about this earlier. Also, emerging markets. It's a struggle for emerging markets if there's a strong dollar at times because they have trouble competing. And certainly struggle paying debt because they own U.S. debt, and it's very difficult. It's also some bit of protection, right, to have a strong U.S. dollar in terms of Apollo talked about, I don't remember the exact number, Robert, I don't know if you remember, but China owns 5% of our debt or something like that. Was that right? Yeah, a little less than 5% of our debt. They're not the largest debt holder. But anybody who holds U.S. debt, they don't want the value of that investment to go down. And that speaks to what Ken was asking a little bit earlier about those places where leverage exists to some degree. Weaker dollar is just the inverse of that. So I think, part of how I was having a conversation with my chief investment officer about this, and part of what he was trying to talk to me about was it isn't necessarily about whether the investor wants a strong dollar or a weak dollar. It's what the investor deals with, because that's not their decision to make. But it may not always be one-sided one way or the other anyway. So, what does it really mean for you from an investment and an economic perspective? So here's why currency matters. Number one, as I mentioned earlier, it has an impact on your returns. So that's the number one reason why it really matters. The second thing is, and this is kind of a double-edged sword of diversification, the guys at the University of Chicago will say that diversification is not a free lunch. Right? And what they mean by that is there's proof that diversification works and it helps mitigate risk. But when you're diversifying, you're going to diversify into some things that don't perform as well as the other things you diversified away from. Right? That's just part of diversification. Well, there's reasons to globally diversify, but when you globally diversify, you do enhance or really introduce currency risk. If you were invested all in the US, you don't have currency risk on your investments. Right? It's global investing in the stock and bond space that really adds currency risk to the mix. Why do we invest globally? Well, it starts with the fact that if we're non-speculative, which that we believe in data, we don't speculate. So if we're non-speculative, then I hate random, right? It really bugs me when people come into my office and I'm like, why do you have that much in that? I don't know. Why do they have that much in that? I'm not really sure. Even as a advisor, when we're introduced to different investments, right? I'm always looking for what's the most kind of mathematical or data-driven way that I can have something in here that makes sense. Well, if you're talking about how to diversify globally, this is a good start. This is market cap across the world. So what you're seeing is blue is the U.S., the grayish color is developed, and the green is emerging markets. This is the market capitalization, the equity market capitalization across the world. So unless you are speculating, you know that a good portion of the world's returns are not going to come from the U.S., but you also know that a U.S. bias does make sense. Okay? And you can see there's oftentimes when people see this, they're pretty surprised. The old version of this had Apple and some of the larger countries, and then it always had Greece, because I think when I first got into the business, Apple was like 17 times larger than Greece, and Greece was all over the news because of the impacts that were happening economically. So it just gives you some perspective. And we do that. Excuse me, let's see. Jim, can you tell me what the middle box on the top? No, I'm just kidding. So the message here is not to be able to pick out a box. It's simply that this is the returns, bless you, of developed countries. And you can just see from this that that's another reason to globally diversify, is because the best returns come from all over the place and they're constantly fluctuating. Okay? And so what the benefit of that is, you're capturing returns that you might not get if you concentrate in one place. The other is that you're diversifying yourself into something that's called non-correlation. And I want to explain why I put this up here. There's a couple reasons. The top line is the S&P 500. Then you can see there's developed country stocks, there's small company stocks, there's emerging markets, and then there's bonds down at the bottom. So the first thing that this does a decent job of illustrating is non-correlation. Non-correlation is the idea that not everything moves in the same direction. And everybody in this room has to some degree heard that conversation, that one of the reasons we globally diversify, besides trying to capture returns that come from other parts of the world, is to minimize risk, because we're creating less significant swings through concentration when we have things that are moving somewhat in opposite directions. Okay? The other thing is this bottom figure down here, and this bottom is Barclays Aggregate Bond Index. The other thing I want people to be aware of is standard deviations. And I know that, to some people is pretty familiar. I know there's a lot of engineers in the room, but to others maybe not. In the simplest form, standard deviation is just how far something needs to move. So you can see the standard deviation of the stock portfolios or indexes on top. They move much more significantly than the bonds do on the bottom. Okay? And the reason that's important is because when we apply currency risk, there's some really significant importance to that. By the way, the bond market is pretty similar. Okay? So with standard deviation, again, the part of the objective is less of that and more of that, right? So how far something moves. Let's just say a stock portfolio has a standard deviation of 10. And it's just a relative term for today, but just say that stock portfolio has a standard deviation of 10 and a bond portfolio has a standard deviation of 2. Remember, currency is a risk. So currency, that's just the standard deviation of the stocks and bonds themselves. Now you're adding an element when you invest internationally of risk that comes from the currency that you're invested in. And let's just say that the currency now adds 2% to that standard deviation. So currency risks adds another 2%. So stock risk goes up to a total of 12, and effectively currency increased it by 20%. You see where we're going though? Bonds of 4, but currency increased it by 50%. So currency risk is more significant in bonds than it is in stocks, by sheer numbers, and adding a level of standard deviation onto an asset class that is otherwise much more stable, because the currency risk is the same, right? Relatively speaking, it's going to be the same in equities as it is in bonds, but it's not going to be the same in terms of its additive or percentage change, right? So what does that mean? Well, mostly what it means is that there's some really smart people that we have here that watch all this stuff, and you guys don't have to. And I'm not one of them, by the way. But, I think it's more than anything, it's just to, one, give just some education about how currency risk manifests in a portfolio. Two, most of you are aware we do something called strategic allocation, where we don't invest in one strategy that covers everything. We have separated strategies that have different objectives. Part of the reason is so we can manage these risks better. We think we can manage them better when they're separated into very strategic objectives of a particular portfolio. So an all bond strategy compared to an all stock strategy has a different approach that we think gives us a little bit of benefit. But it's also just to recognize the nuance. And I'm reminded of this all the time. Maybe I've told this story, but I'll tell it again for those of you who haven't heard it. But my daughter, who's my middle daughter, she's a really hard worker and she's a good student. She's the type that will tell the teacher that she's wrong for missing the 1% that she missed on her test. Maybe, and so she got selected a couple years ago to do her to represent her school with 2 other kids in a math challenge, like against other schools. And I was proctoring one of the tests, and at that time, I can't believe they still call it this, but she was being selected for gifted and talented, which is kind of crazy that we still call it. These kids are gifted and talented. You guys not so much. But never understood that. But anyway, so she, when I did this test, I would ask the question, and her and another student who were both really hard workers, they would grab their pencil and start to work. And then this boy would be like, I know it. And then they'd look at him like, what do you mean you know the answer? Yeah, I know it. And they'd ask him to explain it. And he'd say, I don't really know how to explain it. I just know what the answer is, right? And I tell that story because that's my experience of what we have at CFA levels and in back rooms on our investment team is just the ability to digest this. Because, my strength has always been when I'm talking to my chief investment officer, and he's way up here, like I have to bring it down so I can understand it, and there's a lot of room in between there. So the good news is you got a lot of people who are factoring these things in. If you see portfolio changes, it may be because of tolerance bands, it may be because of economic conditions, it also may be because of currency reasons. And also not just a tool today, but if we continue to see more globalization, we continue to see the US lose more share potentially, there are tools to be able to address that. Which takes me to the last topic, which is valuations. So, did any of you see Kathy Wood? Does anybody know Kathy Wood is? She runs the ARK fund. It's a big tech fund. Did you see her interview recently? No. So you got Bill Gates on one side who says we're moving into a big AI bubble. I'm going to leave that one alone. There's a lot going through my brain on that one. But Goldman says it's going, we're not in a bubble. Bloomberg says we're in a bubble. Market Watch says that we're in a bubble, right? It's, again, this is just always a mission of mine is to try to make sure that for somebody who says this, there's usually somebody else on the other side that will say that. And Kathy Wood, who's a tech investor who did really well, then got beat up pretty good and is doing very well again. She made the case, I'm paraphrasing, but in her interview that not only are we not in a bubble, but we're at the bottom of this thing and it's about to go nuts. So there's such wide-ranging views about where we are in the cycle, right? And we're generally there for 2 reasons. If you think about the data that's discussed as far as why we're talking about the bubble or generally the markets being overvalued, a lot of people feel that way. PE ratios on the left-hand side, and then the market over time on the right-hand side. So PE ratios, why is that important? I think, so PE ratio is price to earnings ratio. Earnings is synonymous with profit, okay? And when you look historically at PE ratios, they're on the higher side. And that causes concern for people to assume that the higher PE ratios mean the market is overvalued. If we acknowledge that that's true, the second thing we'd have to figure out is when will it be undervalued? Because I didn't put it on this chart, but in doing the research, PE ratios were high, really high in 2021, really high in 2017, 2018. Right? And if you think about that, you could acknowledge that those are high. And at some point, if you stay a bear long enough, you're going to be right. right? That's the old adage. So at some point, those you would be able to look back and see those PE ratios are really high, the market is corrected, and they did that in part because the market was overvalued. The problem is you just don't know how long that's going to take. And if you think about those times, what have the returns been since those periods that I talked about? Pretty good. So with anything, it's similar to all market timing, if you're making decisions on PE ratios, your risk is, one, does it tell you what you think it tells you? But two, does it give you any indication in the right timing to address what you've seen? And that is where things get really, really difficult. It's also, I was listening to a podcast in preparation for this as well, and one of the PhDs with dimensional funds was talking about this. You know, Apollo, who you've heard speak, he talks a lot about how we have to always remember the media is here to sell advertising. They're not there to give us financial advice. The other one that came up during this discussion was this information, market-based information, stock-based information, it's probably arguably the most poured over data of any data that exists anywhere in the world. So if PE ratios were really an indication that the market was overvalued and they were some fail-safe mechanism to know where the market was, why would most active money managers underperform their index? Right? It just doesn't stand to logic, right? And furthermore, if you look at this, and I'm not saying, by the way, of all things today, I'm not saying they're not high, and I'm not saying the market couldn't go down significantly because we find out that they were, in hindsight, overvalued. But I am saying it's not a guarantee, and we never know when that's going to happen. And by the way, if you look there, what PE ratios are we talking about? Most of the times we're talking about the S&P 500, which is up there at the top right now. But then we have opportunities to invest in all kinds of different companies. The Russell 2000 at a much lower level, right? Additionally, even if you look within the S&P 500 at the sectors, you'll see some of the same stuff. That it's not all equal. There are some sectors that are pretty low in terms of their historical PE ratios, and some that are really high. Of course, the highest is tech, which is why everybody's worried about the tech bubble. The second thing, and I'm going to digress for a quick minute here. The thing about the AI bubble relative to valuations is we don't really know what AI is going to do yet. That's what Kathy Wood is saying. She's saying, I kind of know that AI is about to take over in a major way, and we're nowhere near, the peak of this. Most people could probably accept that AI is just getting started and there's a lot of room to run. So you kind of have that on both ends of the spectrum. But as an example, let's just say my company triples over the next, let's call it 2 years. I'm just kidding. That's aggressive. Now let's just say the company triples over the next 10 years. And in a normal circumstance, I'd have to bring on 10 employees. But because of AI, I only have to bring on 5 employees, right? What that's going to do is that's going to result in greater profit, right? Greater profit means my earnings are higher, which means that's going to drive my PE ratios down. Well, extrapolate that to NVIDIA or Meta or whatever, right? The potential savings and how that increases earnings. And maybe we look back and say, you know what, because of AI, these PE ratios were abnormally low. Right? They looked high at the time because the benefits of AI really hadn't manifested yet. I don't know that to be true. I'm just saying that's something that I think draws the question of we really don't know how to read into anything, but getting back to the discipline that we have as an investor. On the right-hand side, this is another one that I hear all the time, and this is that markets are at all-time highs. And the main thing you can take away from that is markets are at all-time highs a lot. That's how it's built, right? So if you are scared every time the market is at an all-time high, you're going to be scared quite a bit. All right? So, and I think one of the reasons that I've said that I'm able to be in the middle on a lot of things is because in this business we've been, We've been shown or exposed to the predictions that are erroneous so many times that we don't give credibility to any of them, right? I was just with a guy who's 20 years in a really high level in the military, and he doesn't really trust anybody. And it's like, well, yeah, I get it, because what his experiences are is how could you trust anybody because of all the things he went through? Well, in our business, on the finance side, how could we trust anybody? Because everybody who acts like an expert is wrong 3/4 of the time. except me. That I hit my head. I was like, I just said something about, I'm not an expert, by the way. So if it's breaking records all the time, right, it begs the question, our logic would say if we invest when things are down, we're going to do better than we are than if we invest in them when they're high. Now, that's a really nuanced conversation, but just in terms of indexing, broad-based investing into the market, if we look at things on a weekly basis, from July 1926 to March 2024, 5,000 plus weeks, there were 933 of them that came off of a new high. The return off of the new high was 4 basis points higher than all the other weeks. If we look at it on a monthly basis, 1 year after months where we hit a record high compared to all other months, the record high months were actually up 13.7 compared to the rest of the months at just over 12. We get out to 5 years and they're almost equal. And then if we take it on a yearly basis, after a new market high, 1 year later, 13.9, 3 years, 10.5, 5 years, 9.9, and after a 20% market decline, we're lower in 1, 3, and 5 years. That does not mean I'm advocating to invest in things that are as high as they could possibly be. But it does mean that I think, you just, again, that conventional wisdom that I really need to make sure I'm investing when the market's low, or maybe even more importantly, I should be worried about the markets when they're at a high. The data doesn't really suggest you should. Now, every pullback comes after something. So it doesn't mean that there's not going to be pullbacks and corrections in the market that are going to come after high points. They are, right? But it just doesn't, again, give you indication as an investor that there's something else that you can do more meaningfully. Okay? Every time I rehearsed this presentation, I felt like I was clear as mud by the time I got to the end of that. But that's kind of the goal, I just kind of rehashing back, these are the things that we think are concerns: the dollar, the currency, risk, tariffs. They're all concerns. They're concerns economically, they're concerns from a stock perspective, they're concerns from a bond perspective. Hopefully you have a little more context into how that stuff works. And most importantly, you know that when you hear things on the media, there's usually going to be data on the other side of it. And that's why we just continue to try to do what we do and follow the evidence. You guys, how many people in the room watched the video on the academics? We did it last year? Yeah? Not very many of them? It's on YouTube. It's called Quieting the Noise. Yeah, more of you came to that, I think. Yeah. Some of you guys, I know, we had free food and popcorn, so you guys were there. Come on. But I just love that name, and I always think about it because if you were to look at my inbox on a daily basis, the amount of emails I get that say, you got to put money over here because we got the smartest fund manager, or new fund, or new strategy, or whatever. We're in town. Nowadays, they just say, they'll send me a calendar invite for like Tuesday the 10th without even introducing themselves, I guess hoping that I just accept. But quieting the noise, that's really what we're trying to accomplish. So a couple things, just housekeeping, and then we'll let everybody get out of here. We have some new employees. Hopefully you're getting a chance to see those. Through past client advisory boards, it's always been a concern that's been vocalized that, how do we maintain the service as we grow? I heard it today. And so, we try to make sure that we understand the capacity of different roles and responsibilities and make sure that as those folks reach capacity, we know where we need to bring on new people and continue to add support. So hopefully you're getting a chance to meet everybody. I'm super pleased with the staff that we have, and so make sure that you get a chance to say hi if you see them. I also wanted to acknowledge anybody who was at any of the client advisory boards this year. We had a number of takeaways, but one of the things that we did was pretty significantly revamp our onboarding process. Felt like there was a gap between when people say, yes, they want to hire us, and then when we're running and doing all the things that we're doing moving forward. So unfortunately, for those of you who are clients, that's not going to do you any good. But I just wanted to tell you, thank you for the feedback, because we've made some meaningful changes there. And then last, I just wanted to touch on the referral program and client appreciation event. Hopefully you guys had a great time there. That was fantastic. again, kudos to Amy and Sarah for all that hard work. That was fun. See, the financial stuff gets no claps, the food gets the claps. Yeah. But so I had a reason I bring this up is twofold. One, you guys are probably aware that any business like ours would like to continue to grow their business through referrals as much as we can. Obviously, there's a monetary benefit to that, but there's also a social benefit and communal benefit to that that's pretty cool, a community benefit that's pretty cool in our mind. And we've had a really significant amount over the last few years, so I wanted to thank everybody for that. But we got a question recently that I just wanted to remind everybody. Somebody said, hey, I gave my neighbor your name. And I said, well, we have a referral program, just so you're aware. So I just want to make sure everybody's aware. We have the dinner events at Shanahan's. Every event, we kind of loosely reserve one table. We can do more, of course, but for clients to bring somebody with them, I think that's a great way for them to get introduced to us. It's not missed on us that it takes a little courage to tell somebody about any relationship that you have. But I've just went through a remodel, and there are a few that I want to tell everybody about because there were a lot I don't. And so I think that's a great way. We always want to try to figure out how do we do this in a painless way where people don't feel pressured. I think the events are a great way to do that. Plus, a lot of you are always asking when you can come back to a dinner at Shanahan's, so that's an easy way to come back. Everybody loves that. And then we did our kind of beta test inaugural friends and family event. I think that sticks and something we're going to continue to do. Last year, a bunch of you came to a suite at the Rockies game. Big ticket in town. But hey, it's always fun to watch a Rockies game, okay? Especially if you're a Dodger fan. I was born and raised. I'm not a fair weather fan. So anyway, so we'll do that. So that's just going to be something to just make sure we acknowledge people when they are willing to introduce us to somebody. So no pressure. I never want anybody who's not comfortable to feel like they're ever going to get pressure from us. But if you are thinking about it, that's, I think, the best way to do it is just come to an event. And then if they don't like us, off they go. If they do, then they can engage us on their terms. Okay? All right. Well, this was a tough one for me. Judging by the nodding heads, it was a tough one for a few of you too. But appreciate you guys being here as always.